Hello, welcome to the Economic View. I'm joined as always by Evan Lucas, our Chief Market Strategist. Hi, Evan.
Hello, Tony. How are you?
Yeah, very good. Evan, the Reserve Bank released its minutes yesterday, monthly minutes, 4,139 words, I counted.
Isn't it? It's the longest ever written in the history of the RBA.
I don't know, it's a good effort, but what really caught my attention was what they had to say about household debt. Amongst all the other things, of course, but they talked extensively about household debt and their general concerns around it, I suppose. So what was your take on that?
Yeah, and not only that, we're going to get a special paper out of it. So that shows that not only are they concerned, that they are clearly doing the studies behind it. So my take out of it was probably what they've been saying to us for a little while. They are clearly very much aware that the Australian household market is slightly different to our probably developed, not developing, but developed global peers. We do have a higher level of household ownership. We do have a higher level of investor ownership outside of the corporate sector. So something that Europe and the US has quite a high level of is renting, particularly, is done through corporations rather than where we're here done by basically the individual. And we know that through super, we know that through investor loans, and we've seen talk around possible political implications around that as well, with changes to negative gearing. So that was what they were alluding to. So they are very, therefore, aware that household indebtedness is very high. They are clearly pointing to the fact that wages have grown over the last 10 years, but not at a level to sustain the sustain the kind of level. So that was my take. I will put this out there. They're not worried yet. They are aware of it. They can see it having an effect, but they are also very strong in their opinion that it is actually more middle income and the older generation that are in this scenario that have a much more stable, this is their words, much more stable working environment to sustain it. So that is their caveat, is that yes, there is a high level of indebtedness, but it is owned by a part of the population that can probably sustain it.
Yeah, that was my take on it too, really, that they're aware of it, they're monitoring it, but they're not alarmed at this stage. But something I'm going to talk about in my weekend column is around credit card growth and what's happening there. And the Reserve Bank obviously releases figures on that as well. So I won't go into it too much now, but stay tuned on that one.
Because from my front, getting back to the macroeconomic stuff that obviously that we look at is the three things that were probably therefore ignored, which were probably the three more core things from a central bank point of view, is that they are clearly looking at employment. They still, and I think what you can probably now come to the conclusion is that the June minutes was probably more of a miscommunication rather than a change of tone around the fact that the next rate rise will most likely be up rather than down. It was back in there. So that sentence was back in there. If you look at June to July, it was probably the same, if not slightly a little bit more unsure of the scenario. And again, from looking at the macroeconomics, the most interesting thing from the bank's perspective and from what we've been talking about, which is the funding side, so getting back to the household debt and what would happen around rate rises, is that they themselves are unsure how this is going to play out. They've actually very clearly said that they are watching what's going on in the overnight bank markets, they're watching what's going on in the swaps markets, and the fact that you've seen this move up in interest rates on the free floating market that they can't control is basically what they're saying. And I think from my perspective, that was more interesting, is that they're now watching what the private banks, the corporate banks do, and whether or not they hand it through. Now, that I think is more poignant to this whole scenario and this whole talk, is that if the central bank can't control interest rates because the corporate banks have to deal with offshore funding and therefore the federal funds rate and whatever happening over the seas and all of that, that I think is more of the pressure on household funding, because that therefore means that the RBA can't actually slow down if the banks have to hand through cost extensions.
Yeah, they did allude to some of the banks reducing home loans, particularly for new home loans, and we've seen a bit of that going on, which is quite interesting in itself, because on the other side of the spectrum, banks have been creeping up rates in other areas. So it's probably sort of taking with one hand and giving with the other.
And on that, what's happened this week that's been quite interesting is that the big four are showing signs of starting to flex their muscles with regards to competition. So you have actually seen CBA move interest rates lower for some owner-occupiers across the spectrum. Principal and interest payments, so that needs to be put out there, but they are clearly flexing their muscles because they have the balance sheet, because they have the strength behind them, that they can probably start taking on particularly the regional players. The regional banks are the ones that we're talking about that have already raised rates. Yeah. You've got also Macquarie in there as well, who has raised rates. Everybody's been waiting for the big four, including myself, but it's interesting that maybe competition actually is the other side. And the caveat to this is that they could lower rates, take some short-term pain, and bring home loan lenders over.
Yeah, I'm quite glad to see it, really. Obviously, I have a vested interest in the mortgage market, but that aside, it's nice to see that competition is going to probably keep the banks honest in a way.
And that's the answer, isn't it? I mean, that's the whole thing out of all of this. We can talk about what I've just said around funding, but in the end, if your loan book isn't growing and you are fighting, competition, if you've got the balance sheet to do it, why not fight it? And that's what we can see. So you're right. It therefore means that despite the fact that at one end you've got a funding push-up that could therefore see rates rising, competition could hopefully hold them down. The banks have the capacity to do it. Now, from our perspective, being shareholders and investors that we are, it may therefore see some slight issues on the banking space, but overall it means that there's strength across the market, and it means there's strength in the lending market because competition is doing its job.
Yeah. Another piece in the minutes was about business spending and capital investment, and the Reserve Banks seem to be sort of relatively comfortable in that space.
They are. They have been saying that for a little while too. So the numbers to look here, they come out roughly every quarter. It's the CapEx numbers, so the private capital expenditure numbers. They have been showing signs on the estimates of getting slightly stronger. So it's been a long time for that mining boom to filter out of those numbers that have always dragged on it, and the bank has been saying very clearly the non-mining sector needs to pick up the slack. That's been their language. And you have started to see signs of that. So they are happy that they are seeing that in the GDP. So we saw that private investment in the GDP figures was actually adding points rather than subtracting points away from GDP growth quarter on quarter. So it's happening, and that's why they're now starting to sort of highlight other positive areas, because they are still very optimistic, and they are probably neutral as neutral. But I think they're trying to sort of steer away from being slightly dovish, because that would suggest that they were more likely to cut rates than raise them. So they are trying to find all the real positive parts out of the economy.
All right, Evan, thanks very much for today.
Thanks, Tony.
Thanks for joining us on The Economic View.